Looking to gain an understanding about put options? Want to know how you can make money buying and selling put options? This video is meant for options beginners. I'll be breaking down the basics of put options. I will be showing you how you can make money by buying and selling put options and the risks associated with each strategy. Make sure to watch my previous videos in this series. It'll make more sense and it follows a clear path if you go from the beginning. A put option is a contract that gives the buyer the right, but not the obligation, to sell 100 shares at a specific price and a specific date. As the buyer, you have to choose which strike price you want your put option before you buy it, not after. Keep in mind, you can exercise your option anytime before expiration. Most options will expire at 4 p.m. on the day of expiration, which is usually a Friday, so you can exercise early if you want. Why would you want to buy a put option? If you own 100 shares of a stock, let's say at $100, and it's been hovering for a few months, you think it's going to drop down to $80. So to protect yourself, you buy a put option for the $100 strike. If the shares drop in value to actually $90, $85, or $80, you can exercise your option and you can force someone to buy these shares off of you for $100. When you buy a put option, the price you pay is called a premium. No matter what happens after you buy a put option, that premium is gone forever. If you make money on the option, you still paid that premium. If you lose money on the option, you still paid that premium. It's gone, it's a sunk cost. What happens after you buy a put option can vary, but the price you paid, the premium you paid, that amount is gone. On the flip side, when you sell a put option, you earn that premium. Someone paid you for that contract. Whether or not it's in the money or out of the money, you earn that premium. You get to keep it no matter what happens. If the put option you sold expires worthless, you get to keep that premium. If the put option you sold gets exercised and the buyer's making money on it, you still get to keep that premium, it's yours. When looking at an options table and you're looking to buy a put option, you'll notice the premiums for the strike price closest to the actual price of the stock is the most expensive. Let's take a look at Tesla for August 4th. Tesla is currently trading at $14.72 per share. Take a look at the last premiums paid for each option before the current price. $14.70 strike price sold for $32.75. Then $14.65 strike price sold for less, $30.50. Then $14.60 strike price sold for even less, $28.40, and so on. It continues to decrease. The closer to the current stock price, the more you'll pay in premium. That's because the probability of Tesla going down to $14.70 is high when the current stock price is only $14.72. And obviously it's going to hit $14.70 before it drops down to $14.65. So you're paying more money for a higher chance of income and a higher chance of success. So you have a choice to make. Do I pay more for a higher strike price? Do I think the stock will decrease enough for me to make back my premium and still profit to make the trade worthwhile? Let's answer a few questions on buying put option. How much money can I make by buying a put option? When you buy a put option, you want the stock price to decrease. The more it decreases, the more money you can make. But obviously a stock can't go past zero, so your earnings are capped, your potential income is limited. Assuming you expect Tesla to go down in price, you buy a put option. Tesla is currently trading at $14.65 per share, so you buy an out of the money put option at $1400. Remember, the lower the strike price, the farther out of the money, the cheaper it is. So the $1400 strike is the most you can afford, and it's the most you're willing to risk. Take a look at this graph. I purposely skewed the axis to show the effect. I wasn't able to show a big enough effect on the call options graph, so at least I'll do a better job here. Notice the lower strike price, the higher the returns. You can calculate your gains by taking strike price minus stock price. So if Tesla is $1,000 per share, your gains are $1,400 minus $1,000. That gives you $40,000. But remember, you paid to buy a put option. You paid $11.40 per share or $1,140. So your gain if Tesla hits 1,000 will be $38,860. Your max gain is if Tesla goes to zero. Notice here, maximum return is $138,860. How much money can I lose by buying a put option? Your max loss when buying a put option is pretty easy to figure out. Your max loss is the premium you paid to buy it. If you paid $1,140 to buy this put option, the worst that can happen is it expires worthless and you lose that premium. You're under no obligation to exercise your option. If it expires at a price higher than your strike, you just let it expire worthless. Taking another look at the same graph, you'll notice the graph has a bottom. The bottom line is your max loss. It is $11.40 up until a $1,400 strike, where it slowly increases. What is my break-even point? The break-even point is important. You need to estimate this or calculate it beforehand so you can decide, do I think this stock will decrease far enough to make this trade worthwhile? The break-even point is pretty easy to calculate. It's stock price minus premium. In our Tesla example, we paid $11.40 for the $1,400 strike. That means our break-even point is $1,388.60. So this means we're guessing Tesla will go below 1,400. But even if we guess correctly, if it decreases to 1,390, we're still losing money. Because we paid $11.40 for the contract, we'll need Tesla to decrease by at least $11.40 for us to break even. Back to the same graph. If you look at the break-even point, it's not at 1,400, it's at 1,388.60. Let's answer a few questions on selling put options. You'll notice some of the answers are just the inverse of buying. How much money can I make by selling a put option? Your income, your gains are limited when it comes to selling a put option. When selling a put option, you're earning a premium. The buyer is paying the seller for that contract. So that premium, the price someone pays you for that contract, that is your max gain, your max amount of income. Let's take a look at a graph to see how this looks. Tesla is currently at $14.72 per share. You sell a put option at $1,400. You don't think Tesla will go below $1,400, so you don't mind selling this option. Someone can force you to buy the shares at $1,400 if it goes below. You earned $11.40 per share for selling that option. That's your max gain, your max income. $11.40 times 100 shares. So $1,140. You see the chart is flat at $1,140. All the way up until the stock hits 1,400, then anything lower you start to lose money. How much money can I lose by selling a put option? There's usually higher risk of higher loss when selling options, and that's clearly evident when looking at selling a put option. If Tesla dips below 1,400, someone can force you to buy the shares at 1,400. That's where your losses start. The lower Tesla goes, the more you'll lose. If Tesla goes to zero, someone can still force you to buy 100 shares at 1,400 because you sold them that option. So your max loss is around $140,000. Let's take a look at the same graph. Notice the maximum risk says 138,860. That's because it's 100 shares times 1,400, which is $140,000. But remember, you received that premium, so you have to offset that loss. You received $1,140 in premium when you sold that option. What is my break-even point? The break-even point is easy to calculate. It's the same as buying a put option. It is strike price minus premium. In the same Tesla example, we earned $11.40 for the $1,400 strike. That means our break-even point is $1,388.60. So we're guessing Tesla won't drop below 1,400, but even if it does, if it decreases to 1,390, we're still making some money. We earned $11.40 for the premium, so the shares need to decrease by at least $11.40 for us to start losing money. Back to the same graph, look at the break-even point. It's at $1,388. That's it for the beginner options video. I have no idea what my next video will be about related to options. There's so much to cover and I'm trying to keep it simple. I'm trying to take everyone from the very beginning to hopefully an intermediate level. Be sure to tune into my weekly live trading. I show you what I'm buying, what I'm selling, and my thought process behind each strategy. Thanks guys.